Picture this for a second. You just landed a fantastic public service job in the state of Florida.
Oh, yeah. A big moment.
Great. Maybe you're stepping into a classroom as a new teacher, or maybe you're putting on a badge as a law enforcement officer.
Or even like a high-level university executive.
Exactly. So you sit down at your desk on day one, and Human Resources hands you this massive, overwhelming stack of onboarding paperwork.
It's dreaded first day stack.
Yeah, you're signing forms for your ID badge, your parking pass, health insurance, emergency contacts, just endless forms.
Right.
And buried right in the middle of all that bureaucracy is a single, seemingly innocuous checkbox. Just one little box to tick.
But it's massive.
It really is. That one checkbox will entirely dictate whether your eventual retirement is defined by complete financial independence or severe financial stress.
It's honestly the ultimate hidden trapdoor in career planning, you know?
Yeah.
You are forced into making a multi-million-dollar structural decision while you're, honestly, just trying to figure out where the break room is and how to log into your email.
Right. And that hidden trapdoor is the core mission of today's deep dive. We are cracking open a really comprehensive guide put together by Davies Wealth Management.
They're a fee-based fiduciary advisor, right? Down in Stuart, Florida.
Yep, exactly. And this analysis was created for their 1715 Treasure Toast financial wellness focus. Specifically, we're looking at the Florida Retirement System, the FRS.
Which is a beast of a system.
It is. We're going to tear apart this monumental choice you have to make between the FRS pension plan and the investment plan.
And we really have to look at this through a highly analytical lens. We have to discard the idea that this is a simple, which plan is better scenario.
Because there isn't one.
Exactly. There is no universally correct answer to that question. It is entirely about matching some very complex structural financial mechanics to your highly specific life circumstances.
What saves one person could financially ruin another.
100%.
Okay, let's unpack this because the pressure is actually on from day one. New enrollees in the FRS, they have an 8-month window to make this choice.
8 months. That's it.
8 months to decide the trajectory of your financial future. And if you get overwhelmed, which is easy to do, put the form in a drawer and just do nothing.
Well, the state defaults you.
Right. They default you into the investment plan. You lose your agency in the decision entirely.
And before you can even begin to evaluate your own life circumstances or panic about that 8-month deadline, you really have to understand the fundamental mechanics of what you are actually choosing between.
Right. The absolute basics.
Yeah. It essentially comes down to the structural difference between a defined benefit plan and a defined contribution plan.
So option A is the FRS pension plan, which is the defined benefit plan.
Right.
And the big selling point here is guaranteed lifetime income. The state of Florida is the one bearing all the investment risk.
Which is a huge safety net for a lot of people.
Absolutely. The payout you eventually get isn't based on stock market returns at all. It's based on this very rigid mathematical formula.
They take your years of service, multiply it by an accrual rate.
Based on your job class, yeah.
Right. And they apply that to your average final compensation. But we need to talk about the catch here.
The vesting cliff. It takes 8 full years of service to vest in this pension.
What's fascinating here is how entirely overlooked that 8-year vesting cliff is by new hires. 8 years is a massive chunk of a career to lock in.
It really is.
If you choose the pension plan and life happens like maybe your spouse gets a job in Georgia, or you decide to launch a private sector business, or you just burn out.
Yeah, people leave public service all the time.
Exactly. And if you walk away at year 7, you get absolutely nothing from the state.
Yeah.
You merely get a refund of your own personal payroll contributions.
Wait, so the employer match
Vanishes.
and the potential market growth?
Gone.
Wow. Okay, then we have option B, which is the investment plan. This is a defined contribution plan.
Like a 401k.
Exactly. If you've ever had a 401k in the private sector, the mechanics are going to look very familiar. You contribute money from your paycheck, your employer contributes a percentage, and those funds go into an individual account that you direct.
So you are the one bearing all the investment risk now.
Yes, but the massive upside is that the account is entirely portable and it vests in just 1 single year.
Which is a huge difference from 8.
Right. So the way I've been visualizing this choice, the pension plan is essentially like buying a ticket on a state-funded train, a self-driving train.
I like that analogy.
Yeah, it's highly reliable, the ride is incredibly smooth, and you don't have to know anything about the engine mechanics. But you have absolutely zero control over the route.
None.
And if you decide to jump off the train before the 8th station, you lose your fare entirely.
And following that logic, The investment plan is like being handed the keys to a high-powered off-road vehicle.
Oh, yeah.
You can go absolutely anywhere you want. You can take the vehicle with you if you move out of state or change careers.
But you have to actually know how to drive.
Exactly. You have to perform the routine maintenance, and if you take a turn too fast in bad weather, you are the one who's going to crash into a tree.
So we've established these two vehicles operate on completely different mechanical principles. And the sources make it clear that the very first thing you need to evaluate before picking one is how long your trip is going to be.
Both in your career and in life.
Right. Looking at your career tenure and, quite frankly, your literal lifespan.
Let's look at the career timeline first. The mathematical reality of that pension formula we mentioned is that it only becomes meaningfully valuable after you've put in 20 or more years of service.
Because the accrual rate is just too small in those early years, right?
Yes. The general rule of thumb from the guide is this. If you are absolutely confident you will stay in an FRS covered job for 25 plus years, the pension is incredibly hard to beat.
Because the state carries the risk and the payout is huge.
Right. But if your tenure is going to be fewer than 20 years, the mathematical curve heavily favors the compounding growth you would get in the investment plan.
Okay, so career timeline is one thing, but then the guide pivots to health, life expectancy, and family longevity history.
Which is a sensitive topic, but so important.
It is. Because the pension pays out for the entirety of your life, it massively rewards people who live well into their 80s and 90s. You essentially keep draining the state's coffers for decades.
Right. Conversely, if your family health history suggests a shorter retirement, the investment plan preserves a tangible lump sum of cash that your family can actually inherit.
I have to pause here because this is just wild to think about. When you're a new hire, filling out your HR paperwork on a Tuesday morning, you essentially have to place a financial bet on your own death date.
It sounds morbid when you frame it that way, but yes, you are modeling mortality.
That's intense.
Well, we tend to view longevity risk solely as the risk of living too long and running out of money. The pension solves that beautifully.
That there's the other side of it.
Right. There's also mortality risk, the risk of dying too soon and leaving nothing behind for your heirs. The moment you pass away, those pension checks simply stop.
So if you only collected for 2 years,
The rest of that value just evaporates. It is a cold, hard, mathematical reality that has to be modeled into your decision.
okay, so time and health establish the baseline math. But even if you live to be 100 years old, this calculation entirely changes if you have a complex financial picture.
It really does.
Reading through the Davies Wealth Management materials, it becomes incredibly obvious where generic water cooler financial advice just completely fails high net worth individuals.
Because generic advice operates on the assumption that the employee has no other safety net.
Right.
The classic phrase is, take the pension, you can't beat the safety. And that makes perfect sense for, say, a public school teacher earning $65,000 a year who hasn't been able to build up outside savings.
For them, the pension is a critical lifeline.
Absolutely. But what about a hospital system executive earning $350,000 a year who already has a massive investment portfolio and real estate assets?
Buying a state safety net for them is completely redundant.
Exactly. It's totally redundant.
Here's where it gets really interesting. We are talking about the exact same retirement system, the
Yeah.
exact same forms, but it can produce entirely opposite optimal outcomes depending entirely on your starting wealth.
Yeah.
The guaranteed income stream of a pension might actually be an inefficient use of capital for that executive.
It usually is. And it gets even more complicated when you look at spousal dynamics.
Oh, right, the survivor benefits.
Right. The pension does offer a survivor benefit option, meaning your spouse keeps getting paid if you die first. But the state does not provide that insurance for free.
You have to pay for it out of your own check.
Exactly. You have to take a permanent reduction in your own monthly income while you are alive to pay for that survivor benefit.
So if your spouse already has independent wealth or their own massive pension,
Then taking a pay cut to buy them a survivor benefit they don't even need is a terrible deal.
wow. Whereas the investment plan just passes the remaining account balance directly to their beneficiaries, and it doesn't require you to cut your lifetime income at all to make that happen.
Exactly. Which bridges us perfectly into estate planning goals.
Right. And to understand estate planning right now, we have to look at the current legislative landscape. In 2025, the One Big Beautiful Bill Act permanently set the federal estate tax exemption at $15 million per individual.
Which translates to $30 million for a married couple.
Okay.
And just to be clear, purely looking at the facts of this legislation without taking any political sides.
Right, strictly impartial here, just the facts.
Yes, the factual impact of that threshold is that it drastically changes how people plan.
Meaning, from a pure financial planning perspective, the vast majority of people, even high net worth families, don't have to worry about the federal estate tax wiping out their legacy anymore.
Because the exemption is now so high, the focus shifts entirely to multi-generational wealth transfer.
Right.
If we connect this to the bigger picture, a pension check is essentially useless for generational wealth transfer.
Why is that?
Because a pension isn't actually an asset you own. It is just a promise of cash flow tied to your pulse. The moment your pulse stops, the asset stops existing. You cannot put a monthly pension check into a trust for your grandchildren.
But an investment plan balance is actual equity. Your name is literally on the dollars.
Exactly. It is a tangible asset. It can be passed to children, it can be structured into trusts, and crucially, it can benefit from step-ups in basis.
Okay, let's clarify that mechanism for a second, because step up in basis is a term that gets thrown around a lot.
It's powerful.
Yeah. So if I buy a stock at $10 and it grows to $100, I normally owe capital gains tax on that $90 of growth when I sell it.
Right.
But if I hold that stock in an investment account and pass it to my kids when I die, the IRS steps up the basis to $100. The tax on that $90 of growth just legally disappears. My kids can sell it the next day, tax-free.
That is the power of holding equity over cash flow. The investment plan allows for those kinds of generational tax maneuvers, while the pension plan does not.
So if I'm building wealth, the investment plan sounds vastly superior. I mean, it's portable, it passes to your kids, it doesn't penalize you for leaving your job early.
It's great on paper.
Right. So what is the catch? Because there's always a catch. And looking at the sources, the catch seems to be the IRS, and honestly, the catch is you.
The burden of management is the catch. The investment plan requires the employee to actually manage the funds.
Which a lot of people don't want to do.
Right. You have to rebalance the portfolio as market conditions change. You have to adjust your risk profile moving toward bonds as you age. And most importantly, you have to avoid panic selling when the stock market inevitably tanks.
I want to push back on the idea that flexibility is always a good thing here. Going back to my off-road vehicle analogy, handing total control of a retirement account to someone with zero financial sophistication.
It's dangerous.
It feels like handing the keys of a Ferrari to someone who only has a learner's permit. The first time it rains or the first time the market drops 20%, they're going to crash it into a wall.
The data absolutely backs up your analogy. Morningstar has done extensive behavioral finance research, tracking the gap between investment returns and investor returns.
Okay, what does that mean?
Well, the investment fund itself might return 8% over a decade, but the average retail investor in that same fund might only see 5%.
Wait, really? Just because of how they trade?
Yes. The mechanism behind that gap is pure human emotion. People sell when the market drops because they are terrified of losing everything, locking in their losses. Then they buy back in when the market is peaking because of FOMO.
Oh, wow.
The rigid structure of the pension completely insulates you from your own bad behavior. The investment plan leaves you entirely exposed to it.
Which is why the guide stresses that if you take the investment plan, working with a fee-based fiduciary advisor is essentially mandatory to protect you from yourself.
You need someone else holding the steering wheel when the road gets icy.
And you need them to navigate the tax traps. The guide outlines how the investment plan offers tax-deferred assets that can be heavily manipulated to your advantage. Right, like you can roll them into IRAs, you can execute Roth conversions, paying taxes now at a lower bracket so the money grows tax-free forever. You can use qualified charitable distributions.
Which is where you donate money directly from your IRA to a charity so it never counts as taxable income on your return.
Exactly. And you can carefully manage your required minimum distributions, or RMDs, to avoid triggering IRMA.
Remind me, IRMAA is the Medicare thing.
Yes, the Medicare premium surcharge. It's a massive hidden tax for high net worth retirees. If your taxable income pushes even one single dollar over the Medicare threshold, your Medicare Part B and Part D premiums skyrocket for the entire year.
That is brutal.
It is. But with an investment plan, you have dials you can turn. You can choose exactly how much money to withdraw and when, allowing you to carefully navigate just under those tax thresholds.
But pension income have no dials?
None. It is inflexible. Ordinary taxable income. It just stacks on top of whatever else you make. Social Security, rental income, spouse's income, and pushes your tax bracket up. The check arrives in the mail, and the tax bill arrives right alongside it.
You have absolutely zero control over the timing or the taxation of a pension.
This is incredibly complex. Let's say you're listening to this and you realize, uh-oh, I might have picked the wrong plan years ago. Or maybe you just got overwhelmed at onboarding and the state defaulted you into the investment plan.
It happens all the time.
The state does offer a one-time switch mid-career, right?
Yeah.
But Davies Wealth Management warns that this switch is often a total financial trap.
It creates a really dangerous illusion of safety. You are legally allowed one plan switch in your career. Let's say you defaulted into the investment plan at age 25, and now you are 40.
Okay.
You decide you want the guaranteed safety of the pension. To switch back, you have to basically buy your way into the pension fund.
How does that work?
The state calculates the present mathematical value of the pension benefit you are trying to claim, and they pull that money out of your accumulated investment plan balance.
I'm assuming that is not a cheap transaction.
It is astronomically expensive. That transfer can consume a massive percentage, sometimes nearly all, of the investment balance you've spent a decade and a half building.
Wow.
You are sacrificing all your flexible, portable assets just to lock in the formula. You essentially drain your own wealth to buy a state annuity.
To make this entirely concrete, let's look at how this plays out in real life.
Yeah.
I want to contrast 3 different scenarios. Let's start with a 30-year-old law enforcement officer.
Okay.
They have modest outside savings they plan to put in their 25 years, and they don't have massive generational wealth transfer goals.
For them, taking the pension plan is a no-brainer.
Right.
The formula guarantees them safety, and they are putting in the years to maximize the math. That is the textbook use case for the pension.
But contrast that with someone who enters the state system much later. Imagine a 45-year-old hospital administrator.
A late entrant, yeah.
Right. They already have an $800,000 portfolio from private sector jobs, and they plan to retire at 62. They will only have 17 years of FRS service.
They should clearly take the investment plan. The pension formula won't have enough years to ramp up to a meaningful number, and they desperately need the portability.
Then you take the extreme high end. A university executive making over $300,000 a year with a $2 million existing portfolio.
Again, the investment plan wins, but for totally different reasons.
Because of the taxes.
Right. The pension payout would just be a tiny fraction of their overall income, but that rigid taxable income would ruin their estate planning and trigger all those Medicare tax cliffs we talked about.
Right.
This raises an important question, though. Why do people wait until mid-career to analyze these scenarios? Many employees rely on the generic switch estimate tool provided by the state at myfrs.com.
Is that a bad idea?
It's highly dangerous for high net worth individuals. It only looks at the raw FRS numbers. It is completely blind to your spouse's wealth, your existing portfolio, your estate goals, and your tax bracket.
It's too simplistic.
Relying on a generic, isolated calculator to make a multi-million-dollar structural decision is financial malpractice.
So what does this all mean? It means that making this choice by default or relying on what the person in the cubicle next to you did is the biggest mistake you can make.
Absolutely.
This isn't just about picking a mutual fund from a drop-down menu. It requires fiduciary-level modeling of your entire life. You have to look at your total compensation, your spouse's wealth, your health, and your tax situation before you ever check that box.
It requires zooming out and looking at the entire architecture of your financial life, rather than just treating it as a single HR onboarding form to get out of the way.
And that brings me to a final thought I want you to mull over today. Something that really stuck with me as we were analyzing the timeline of these plans.
Yeah.
We know the pension plan locks you in with that brutal 8-year vesting cliff, right? And it really only becomes highly lucrative if you stay for 20 or 25 years.
Good.
Meanwhile, the investment plan is fully portable after just one single year. So here's the question. Could choosing the pension plan at age 25 subconsciously kill your career ambition?
Oh, that's an interesting way to look at it.
By voluntarily slapping those golden handcuffs on yourself, you might wake up at age 35 terrified to take an amazing private sector job offer, or terrified to take the leap and start your own business simply because you don't want to lose your unbranded pension.
The psychological weight of unvested benefits is an incredibly powerful anchor. It can keep you in a job you've outgrown purely out of fear.
You might think you're just picking a retirement plan, but your FRS election form might accidentally be dictating the entire trajectory of your career and your life's ambitions.
It really is that big of a deal.
It really is. Well, thank you for joining us on this deep dive into the FRS system and the Davies Wealth Management Guide. We encourage you to take a deeply active role in your financial wellness, and remember, the next time you are handed a stack of onboarding paperwork, don't just blindly check the box.